students, thank you, Zand, and outside participants. My name's Abby, and I'll be hosting the session today with Tim and Sarah. So thank you again for joining the Entrepreneurs Change the World program. Before we get started, I want to give a special shout out to our sponsors and a big thanks to Kroger, PMG, KMK, Taft, and of course, First Financial. Obviously, without them, this presentation and programming would not be possible. As always, if you have any questions during the presentation, please feel free to put the questions in the chat or unmute yourself, depending how you feel today. And of course, as always, like I say, there will be a survey at the end. So please feel free and please actually fill out that survey. We love to hear feedback and would love to help make changes to make this program even better for next year and for next time. So without further ado, I'm going to hand it over to Tim and Sarah.
Thanks, Abby.
Thank you, Abby. And to all of you, thanks for your time today. It's great to be here, and I love seeing interest from a diverse community in financing startups and kind of diving in a little bit more there. It's a very important topic. I'm Sarah Phillips. I lead strategic partnerships and investments for Great American Insurance. My background, I was previously at Kroger and Fifth Third in similar roles. I have done private equity investing from a lower middle market perspective, venture investing, and then in a prior life, investment banking. So I've kind of come across the gamut and hopefully can bring some insights to bear.
And we had a chance to work together before.
And we did have a chance to work together before.
Which was where?
Which was at Centrifuge. Right. Oh my gosh, I totally skipped
You
over
forgot.
that.
Oh my God. That was the most important milestone in your life, I thought.
That was the most important milestone.
Okay.
Yeah, no, that's okay. Sorry. My most important job was 6 months as a consultant at Centrifuge when Tim was running the fund here and Sarah Anderson had just started. And I had just moved to Cincinnati. So that was 7 years ago.
Oh my gosh.
Oof, I feel old. But those were the best days of my life. And so, yeah, that's how I got to know Tim and the whole Cincinnati community.
That was a lot of fun. Good thing we're doing this today.
I know. Wow, things come full circle.
Yeah. So I'm Tim, founder of Refinery. I started Refinery in 2017. I'm originally from Cleveland. I went to Case Western Reserve University, studied electrical engineering, came to Cincinnati for my first job. I was actually hired in a small company. I was the 10th employee of a small company that worked a lot with Apple. And that started my connection to Silicon Valley and the West Coast. And our biggest customer was Procter & Gamble. I did a number of different international stints, got into venture capital. Turns out there was a local venture firm. The first venture firm at Cincinnati was Blue Chip Venture Company in 1998. So I joined them, was there 9 years, went through the internet boom and bust, and launched a company called Share This in 2007. So whenever you share something on the internet, you see a little sharing symbol. So I created that, the first person to recognize that what people share is actually more important than what they search in terms of how we get information. And then Centrifuge, helped start Centrifuge, the fund of funds, and investing in other early stage venture funds. We invested in over 20 VCs, which means we're investors in about 600 startups. So I probably been involved now, if depending on how you count those numbers, 1,000 or so startups.
That's awesome.
Probably.
Yeah.
And then started Refinery, like I said, in 2017, focused on early stage tech companies and helping them generate hypergrowth. So that's our background. We definitely want a lot of questions, right?
Yes.
Because this is just us talking to ourselves, which we can do.
We'll have a ball
easily. We'll have fun, but we want you to get something out of it. So please make sure you ask questions at any time.
Yes. Try and trip up Tim, see if you can trick him.
So how are we going to organize this conversation?
Okay, so We have a couple of slides here that with an understanding that those of you on the line are either high school students, university students, or professional entrepreneurs, investors, anyone in the community that has an interest in this topic. We wanted to make sure we hit on all levels. So we have some kind of one-on-one slides just to make sure everybody's got the basics from a terminology perspective, and also some perspective on how immensely hard it is to build a successful startup, and with an acknowledgement that there are many, many ways to fund it and kind of hit those growth metrics that you're looking for. But some are better than others at different stages. And so that's, I think probably one of the takeaways we want you guys to have.
So at the beginning, we were joking, the pocket guide for entrepreneurs. We didn't know what a pocket guide was exactly.
We did not.
whether you can put Zoom in a pocket or not.
On your phone, I guess.
But how about the other thing? What's an entrepreneur?
Right. Yes. I have the pleasure of sitting next to a real live entrepreneur right now. So Tim, maybe you can start up, and let me see this first. Oops.
No, Abby's doing
Can you
it.
go to the next slide?
Next slide, you got it.
Oh, okay. Well, let's start with Tim's. Actually, go back. So it's
All right, we'll go back.
Sorry for that.
No, you're absolutely fine.
As an entrepreneur, how would you describe entrepreneurs in general, and how would you think about some characteristics of a successful entrepreneur?
Yeah, I think a lot of people think entrepreneur, if you say I'm an entrepreneur, they think of somebody who's resourceful, who's a really good problem solver, maybe as somebody who's creating a business, but not always. You say somebody's very entrepreneurial. What does that mean, right? That you think they're somebody who solves problems,
Yep,
right?
That's fair.
So, and then corporations will talk about having intrapreneurs, which are entrepreneurs that work inside a corporation, right? So entrepreneur can mean a lot of different things to a lot of different people. And there are also a lot of different types of companies, right? And so our perspective, we live in a world with startups that are venture capital backed, that raise a lot of money, which is just a subset of all the entrepreneurs out there. There are millions of entrepreneurs out there, right?
Yes.
And a small set that use venture capital. So we're going to kind of go an overview of all of those things, but then go deeper on the VC side. So hopefully that's a helpful clarification.
Yes. So we'll start true to the name of our talk today by talking a little bit, Abby, if you can go to the next slide, about what bootstrapping means. And then we'll talk a little bit about where bootstrapping sits in terms of all the funding for all entrepreneurs out there, which you may find a little bit surprising. I don't know, it always surprises me when I look at those stats, because in my world and in Tim's world, everything is venture backed because we are venture backers. So, but a lot, and in fact, the vast majority of startups start with bootstrapping. And so that means that you're growing your business with little or no venture capital or outside investment, right? You look at your own savings, you might look at a paycheck that you have from a job when you're kind of doing it on the side to fund your business, revenue that you generate within the business to recycle and to fund growth. Some people use credit cards or take on debt or a home equity line, right? When they really believe in something. There are a lot of ways to get something off of the ground, and the first place to look to start to prove out your company, your product, market fit, whatever you're trying to build, your technology, which is often the case these days. The first place that you typically look is your own resources. And when you take on debt or when you take out of your personal savings, it's really important to understand the implications of that, and kind of understand whether you're going all in, and also understand the probability of success of your startup in terms of the impact on the rest of your financial life. So
interesting. Probability of success.
Yes.
So if somebody came to you and said, hey, I have this idea and I'm going to take out a big home equity line or use up all my 401k and I'm 30 years old and I'm going to go do this for this idea. What would your response or your recommendation be?
Don't do that.
Exactly.
Seriously.
Right. I'm glad you answered that way. If you like that person.
Yeah.
It's a good point. I mean, because this could be misleading, right? Because personal savings, credit cards, you go, oh my gosh. But seriously, like if you don't have the ability to go without income for a relatively long period of time, a year, it's hard enough to build a business, let alone put on the pressure of not being able to pay your bills or pay your rent. Nobody wants to invest in somebody who's worried about how they're going to pay for their rent or buy dinner.
Right.
And you don't need to put yourself in that situation.
Right. It's a tricky one. And also, oftentimes, and I'm sure we'll get into this later, but investors look at use of capital, right? Yes, I want to put money into your startup, into your idea. How are you going to use the capital? And if a big portion of that is to pay myself, then there's a conversation that's needed to be had and a lot of thinking that both sides need to do.
It's actually interesting because when I was a first entrepreneur, before I learned about venture, I expected investors wouldn't let me pay myself at all.
Yeah.
But that wasn't the case.
Okay.
If they're investing in the company, they do expect you to have something. They don't expect you to live on ramen noodles all the time. But
just
you're not going to, right. You're not going to pay yourself a lot.
Yeah.
But you might be able to pay yourself something, a living wage, right? Yeah. But not a lot.
That's fair. That's a good point.
Yeah. So, and you want to be able to use that money to do some research or build a product or pay for some other people, right? And so I think one of the things we'll probably mention a lot in this talk is alignment, aligning incentives with yourself and your investors and others.
Yes.
And, there are definitely stories out there of people who've risked it all for companies. Yes. And so that doesn't mean that doesn't happen, but vast majority of the time.
What percentage of people would that represent?
Less than 1%, a very, very, very small percentage. Matter of fact, interesting stat. So disclaimer, we may reference stats and they're directionally correct. but you may have to look up sources to get the most up-to-date information.
That's fair. That's right? Fair. Because as we have been around this for a while, I'm sure if you Google 2020, 2021 stats, they might have shifted a little bit.
Yeah.
But
so there's an interesting study that was done about 3 years ago by a team headed by an MIT professor that looked at the average age and median age of an entrepreneur of the fastest growing companies in the country.
Okay.
So let's say it was 1,000 companies or so, stack ranked, fastest growing, largest, and
Inc. 500.
And they looked. Some of them would have been on the Inc. 500, not necessarily all of them. What do you think the median age was of the entrepreneur of those companies?
50.
40.
Okay.
Plus or minus 1 year.
Wow.
So there's this sort of myth, that the Mark Zuckerberg makes for good magazine covers, Harvard dropout, the Harvard dropout story.
Yes.
That's also very rare.
Right.
And the reason that most of the entrepreneurs are about 40, I was 39 when I started to share this, is you've learned something. So you know something about some subject.
Yes.
And you've built up a professional network.
Yes.
Which is a huge asset when building a company. And if you didn't have a network, right? So there's benefits of being younger because you are you can sometimes take a fresh approach to things. But any young entrepreneur that I've met has surrounded themselves with a lot of really good advisors and mentors that help them learn faster.
So here's a question.
Yeah.
Of those 40-year-old successful entrepreneurs, how many of them do you think had a prior startup that failed? 80%
of them.
I would guess that too.
Yeah.
Yeah.
Yeah. We learn best from failure.
That doesn't mean wait till you're 40 if you've got a company that you're interested in building. But what it does mean is, even within a single entrepreneur's career, to have multiple successful startups, you read those stories, and I think that is just fascinating. But, you will see, kind of learning on the job. Being an entrepreneur is super tough. And so going through it and having a failure, and then coming back to it shows an immense amount of grit, and it can lead, to different outcomes based on all the things you learn.
And the most important thing is to learn.
Mhm.
Second most important thing is to learn quickly.
Yes.
Like, it does not help you to work on a failed startup for 10 years
No.
and then emerge when you're in your mid 30s and say, I failed. So if you're going to fail, fail fast.
Yes.
Because time, you cannot, obviously time's your most precious resource. And just final thoughts on entrepreneurial as we're talking about it. I mean, think about what are the most important attributes of an entrepreneur?
Okay.
What
Was that a question for me?
That's a question. What do you think?
Okay.
And everybody else. Oh, we got questions on chat,
Ooh,
maybe.
whoa.
You go ahead and answer that, and I'll read.
Okay.
You answer the question.
Characteristics of an entrepreneur. I would say there are a couple of things, right? A lot of CEOs have very, very deep expertise in the field in which they're innovating, right? So if you're going to build a technology company, you likely have very, very deep knowledge of the type of technology that you're utilizing, and whatever it is, you go deep on a subject, but you have at least cursory knowledge or an inch deep across many, many, many subjects, like finance, to be able to kind of understand the right way to manage your P&L of your business. And as you take on investors, kind of understand the way capitalization tables work, and kind of be able to have that knowledge of running a business and HR and all the different things that reading legal docs, right? There's a lot of different things that suddenly you find yourself doing. And so it's not just having deep expertise in the area in which you're working, but having the ability to kind of go up and down that ladder in terms of like strategy down to minuscule points in a legal doc, and then back up to, some different topics. And so I think a typical day of an entrepreneur is bopping around to a lot of different things, and being able to handle that with grace and still start to, keep your eyes on the horizon and marching towards something is important. I think grit is important. Mm-hmm. And I think you should be fun too.
Those are good ones. Those are real good. And matter of fact, the on the multi-subject thing, that's one of the reasons why I like being an entrepreneur. I used to say at one point I'm talking to a scientist, the next point I'm talking to a CFO, and I like both of them. Yeah. Like, I enjoy both of those conversations, right? It makes my day fun.
And self-awareness.
Yeah, very good.
Self-awareness. Know what you're good at and lean in, and know what you're not good at, and build the right team around you to kind of make up what's needed.
Well, that relates to the one that I had in mind for a top attribute, which is to be a good listener. Because at the end of the day, when we evaluate businesses, the number one thing we look at is the market.
Yep.
And good entrepreneurs are good at listening to the customer and listening to the market, yep, as well as their employees. And then the second attribute I was going to bring up is the leadership component, actually leading people. If you've never led a group of people before and haven't been able to demonstrate leadership, not because somebody gave you a title, but because you are a leader, it's going to be very hard. You spend most of your time recruiting people, leading people, organizing people, motivating people,
inspiring people.
So if I had to pick one thing to learn, if you want to be an entrepreneur, it would be how to manage and lead people.
Fair enough.
All right.
So
we have
those
some
are
questions.
all questions to ask yourself, or things to think about as you're thinking about emptying your life savings and putting them into your startup.
So we had a couple these good questions here. Chad, I guess these are all to everyone so everybody can see it. Chad's situation. So Chad, basically you need to pay yourself. If you're generating revenue
yes,
and growing, paying yourself should be one of the costs that you include in this. And if you're not,
so the answer is that revenue should be enough to cover operations, but there is an additional transactional cost. Like I'm a healthcare staffing company, and every time I bring a nurse on, there's about anywhere from $1,500 to $2,500 of transactional cost that I didn't calculate for in the beginning. So like the credit card pays everything monthly, and the cash advances on the credit card are like ridiculously high interest rates. And so like, I'm a poor boy who's trying to make it in the world, and I don't have any problem not taking money and working part-time jobs on the side. I really don't. And but with the high cost of taking on this, like putting it on the credit card as a cash advance, there's just got to be cheaper money out there. And so that's really where I'm at. And certainly if I went the investor route, that I completely agree. I mean, I would take a minimum expense, payment to myself. I like that. I agree 100% that that's a that's a surefire no to an investor when your business plan is to pay yourself a six-figure salary or whatever with the money they're giving you.
Yeah. So what you're bringing up is a good point, and we're not going to get into specific problem solving here. It's like a radio talk show.
I know.
But I think the principle, Chad, is that you can sacrifice in the near term. I did and do with Refinery as I built it. But at some point, I have a financial model where I make money. And the key thing is, and this will translate to what we'll move on next, which is how to finance it. The key is finding investors who understand your specific type of business, understand its model. Mm-hmm. That's going to be the best source of capital you can get, regardless of whether it's venture or a bank or friends. You want people to understand your business and help you through that. And if you show, hey, look, I've got a cash flow gap, but once I get to a certain level of revenue or customers or gross margin, then I have breathing room, right? And you just need somebody to get you through that gap. And that's totally acceptable. So don't,
build a model.
Build the model to what the end result is.
How much money you need, give a little bit of cushion there, and contemplate, a living wage for yourself as well, right? So that you're 100% of your time and focus can be on building that and not on this job and then that job.
Yeah.
I mean, that opportunity cost and your burnout is really important too. So I think that's all very fair.
And that relates to Ellie's question. Where she says, entrepreneur is a risk taker.
Yes.
Do you think that's true?
So here's the thing. Yes and no. I think that entrepreneurs have a different understanding of risk than a typical, let's say, corporate, suit. And I'm a corporate suit, so I won't throw shade. But yeah, I do think that I do think that when you build a business and you concentrate all of your assets into something that has a statistically lower chance of succeeding, I think that your understanding of risk has to be shifted from the typical person so that you go down that path. Is that fair?
Yeah.
What do you think?
I take the contrarian view, which is I don't think entrepreneurs are risk takers. I think they're risk managers. It's just like a good poker player.
That's
you
fair.
have to know your odds. And if you want to be a good entrepreneur, you get the odds to stack in your favor. A good entrepreneur doesn't say, I'm going to go sell to a market to customers who would never buy what I have. That would be ridiculous. That would be a risk taker, right? I want to line everything up so that I'm selling to people that I know I have a high conversion rate on, right? And as an individual, as a person, I also view, the people might think entrepreneurs are risk takers, but I view it as more risky working for a big company for me because I'm not in control of my destiny.
That's fair.
As an entrepreneur, I think a lot of entrepreneurs share that. They're confident enough to be in control of their own destiny, and it's more risky being dependent or reliant on other people for that.
See, we have a different understanding of risk.
And they're both.
No, and that's fair. You're an entrepreneur, but I do think you make a very good point where you say, "Hey, my statistics are less than 1% of success the way that I mitigate that risk is through my network, my expertise, my business, having a strong business plan, and really kind of seeing, having milestones and KPIs where you say, okay, end of year 1, I must be here.
That's an
end of
awesome,
year 2, I must be here.
that's an awesome point. I bring that up a lot with folks, and I find that they don't do this enough. And I don't even see much kind of business magazines and advice talk about this.
That's fair.
Set dates.
Yes.
Hold yourself accountable. Have your mentors and advisors or your family hold you accountable to dates.
Mm-hmm.
Like, look, I want to get this stuff done, and I need to get it done by the end of this year.
Yeah. Okay.
And if I'm not anywhere close to getting that done by this year, I got to reevaluate my assumptions.
My life plan or business plan.
Some people just think it just keeps going and going. And
that
when you
also
know to
helps
stop.
you pull your head out of the daily grind and say, am I where I need to be? Because that's super hard to do. And when you've got grit and drive and you're just going, it's tough to gut check.
And often we do make the wrong assumptions, right?
Mm-hmm.
We're not as informed as we thought we were. We thought, well, I could get 20 customers by the end of the year. That should be easy.
Yeah.
And
no
if you get 18 or 19, okay, that's not bad, right? But if you got 5, what's that telling you?
Be competitive with yourself.
Yes.
Okay. We are halfway through and we have not talked very much about finance. So
what's the next slide? Do you know?
Let's go to the next slide. Okay.
Nice.
We alluded to this earlier. More than 80% of startup operations are funded by the founder's personal finances, right? And the median startup capital is about $10,000. So this always surprises a lot of people, even entrepreneurs, even investors. When you look at, that kind of tallest bar to the left is personal savings and credit. The next is friends and family. And then you see venture capital there. And I'm not sure the date of this slide, but again, it's directional. And venture capital and kind of angel investors, right, aren't too far off from each other. But banks don't understand risk in the same way and have a really tough time underwriting a company where there's not a solid historical EBITDA trend, right? So that's a trickier one. You can get a loan, but and then put the money towards your startup, but banks are tricky. And then crowdfunding. A lot of people turn to crowdfunding. I don't know. It's an option, but
so not all startups should seek venture capital.
That's right.
Or another way to say it, you should seek the right type of the appropriate capital. Back to comments that were made. So again, directionally correct. Interesting stat. I think it was like 22 million businesses in the U.S. What percentage of those businesses do you think have over $1 million in revenue?
Should we crowdsource an answer?
Yeah, I want to see some stuff in the chat bar.
I see some stuff in the chat bar.
What percentage of 22 million businesses in the U.S. have over $1 million in revenue?
40. Much lower. 25. Okay.
Not quite.
Abby's getting in the game here. Now you guys are just guessing lower numbers.
That's good. That's good.
Well, when you say lower, Sarah, I mean, how low can you go, really?
No, 2116. Okay. Who's our winner?
The answer is 4%. So in other words, 96% of businesses out there have $1 million or less in revenue.
Oh, yes, we can
explain. We'll explain what these things are here
all
in a
of
second.
these things
Zan.
are.
So $1 million or less in revenue. 0.4, a tenth of those have 10 million or more in revenue. Right? So we read a lot about the big companies, but it's very, very small percentage of the overall company. There's a lot of entrepreneurs out there that make a living, maybe make a good living for themselves, but that's the vast majority of businesses.
That is a fun stat. And that was a fun guessing game.
So if you're going to do venture capital, you have to be in that thinking you're going to be in the 0.4% of companies.
That's right. And some don't aim for the stars, but nonetheless.
Okay.
So let's go through. Yeah. So let's go through what each of these means. I think the first one we covered ad nauseum on the last slide in terms of personal savings, and credit card, someone here has utilized their credit card to fund the business. Friends and family, that's a tricky one. It's obvious what that is. You ask your friends and family for, money, and in exchange for the money that they give you, you give them an equity stake in your company. An equity stake is a percentage ownership of the company. So presumably when you start, you've got 100%, and we'll look at that in a second. But raising money from friends and family, if it fails, can get a little awkward at Thanksgiving dinner. So,
and they may not be able to help you much.
And they might not
may
be
may
good
not.
advisors, right? When you take on money, you give up a point of equity for any capital coming in. Really, the right place to look, in my opinion, and it depends, right? You take what's available to you, and you know what you need, and you know your ideal, and you know when you're kind of just taking capital, and you'll get there later. But taking advisors on who can help chart the growth, and I've seen thousands of companies go down the same growth path as you, and seeing the issues that come up and can advise you through it. Those are really valuable investors, and that's why a lot of people turn to venture capital and angel investors, right? But from a venture capital perspective, Tim here happens to run a venture capital fund. So why don't you explain what that is?
Do you hear that pounding, Abby?
Yes, is someone knocking on your door wanting money?
We live in the hood. We live in the hood here, and or work in the hood, I should say. And I thought my crisp microphone was going to block that out. They're
literally
drilling into the
hammering the street.
Oh, so that's not someone knocking on the door looking for an investment. That's just a hammer.
I just hit the noise reduction wasn't on before. Now it should, they stopped.
Let us know if it's too much.
So venture capital is organized capital, professional capital, I'll say, because they're full-time focused on investing in high growth, high margin companies, high margin being high gross margin companies. My rule of thumb is the only time you really want to raise venture capital is when you intend to build a market leading company, meaning a company that's going to dominate a certain market segment. If you're not going to dominate a market segment, don't raise venture capital, because the valuations, the reward in the industry goes to the market leader. Nobody else gets valued very much, right? So if you're building, there's no problem building a successful business, a construction business, let's say. There's thousands of construction businesses.
Yeah.
You don't have to be the market leader to be a good construction business that makes good money for you and your family and everybody else, but that's not going to be a venture capital backed business.
No. And so venture capital are typically, either previous entrepreneurs or professional investors, financiers, who they themselves go and raise a money, a blind pool, typically, meaning, I'm going to raise $100 million or $150 million, and my plan is to invest in 10 companies, and I'll invest in them early stage, and then when they come out for more funding, I'll continue to invest in the winners, and at the end of the day, when they exit, we'll all reap in the rewards of that business. And so in terms of, Tim, money on invested capital, so if you put in $1 into a company, how many dollars do you typically want back out?
100.
Okay, well.
That's the model. So there's a famous quote by a famous VC, Bill Gurley from Benchmark, who did Uber and other things, who said, venture's not the home run business, is in the grand slam business.
That's fair.
The point is, we're here for the outliers. We're here to get the 100-to-1 winners or 1,000-to-1 winners. And we actually don't make money if we just double our money or triple our money on a given investment.
That's fair. That's more of a private equity goal.
So that's an interesting point, right? Each of these things on the graph are different risk tolerances.
That's right.
And the risk tolerance is inversely correlated to the return you expect.
That's right.
So if it's high risk, I want 100-to-1.
Yep.
If it's a lower risk, I might want 10%.
So how do you construct your portfolio? You want a number of your portfolio companies that shoot for 100x.
Well, I want all of them start that way.
Okay.
they don't all end that way.
Then what's your typical experience?
The typical experience is actually super simple. It's a third, a third, a third.
Yep.
A third are those Grand Slam candidates or Grand Slams. A third are companies end up returning about 2 or 3 times your money. And then a third fail and return either zero or a partial amount of your money. So that's pretty true across all of venture capital.
It is.
So they all start out thinking they're going to hit a Grand Slam. Maybe a third of them have a chance of a Grand Slam and hit something that's like above 3 times your money. And then the other 2/3.
Okay. My fun fact that is directional is that 7% of venture-backed companies return 60% of profits for venture investors. So if you think about that, right?
And we look at, just to add to that number, we look at 100 business plans a month.
Yeah.
And we only do like one every 3 months.
That's fair.
So 1 out of 300 companies that will fund. And even those ones that get funded, only maybe a third of those or less are actually successful.
Yep. And the companies that we'll put money into, right, from a strategic investment perspective, it's even more selective because those companies actually take a ton of work once they're kind of in the family to stand up things from on the commercial side. So there's a lot of time. You can only allocate so much time to so many companies. And so we see a ton that come through, a ton. And yeah, you can't do them all.
Do we need to finish the definitions on this?
Okay. Yeah.
Angel
investor. What's an angel investor?
So angel investors are typically groups of individuals, a lot of times lawyers or doctors, other entrepreneurs that you raise money from individually that are actively either as a hobby or as a living in their retirement are investing. And I'll cover the crowdfunding because it's kind of related. So crowdfunding is sort of an evolution of angel investors where it's more organized, where the key difference being in crowdfunding, you basically post your business plan and then everybody individually decides if they want to invest in it or not. And that can happen in crowdfunding and angel investing. In venture capital, it's called blind pool investing because our investors just invest in a pool of capital. So in our case, $25 million fund, they don't have any say on the investments. They just invest in what I say. Whereas angel and crowdfunding, the individual is still choosing whether they want to invest.
Deal by deal. They look at all the deals. They say, I'll do this one, but they don't all have to do it.
Right.
And I will say the one other differentiator between angel investing and crowdfunding is that angel investing, hopefully you get some expertise and guidance. Crowdfunding, very low chance.
Right.
And then banks. You all know what a bank is.
So one of the confusing things that comes up a lot, and I get asked a lot when you are fundraising, if you are going to raise money from angels or venture firms, is valuation and dilution.
Yes. Huge thing that everyone should understand before they take on money.
Yes, and talk to people who've raised money so you know what you're talking about.
That's right. Which brings us to our next slide, I think.
Yes, Abby. Because one of the things that if you're talking
go to the next one, we'll just skip the.
Yeah, we'll
this
skip
is
that.
kind of the same as last.
If you go to investors and you're trying to raise money and you sound naive about fundraising, what happens?
You get crushed.
I was looking for a nicer answer. You're right, though.
No, it's true. Or someone kind of takes you under their wing and is like, no.
If they're nice, if they're super nice and they have time, they'll do that. But if you're talking to somebody and raising money from them and you don't understand how they invest or what type of valuations they look at and all those kind of things.
Or what valuation you could get in the market.
Right.
Don't take the first money that comes. Talk to 5 people and see if the valuations that they're thinking are all over the board.
And it's a classic mistake of
align over. Yep.
Sometimes early entrepreneur or new entrepreneurs say, "Oh, I have this great idea, blah blah blah, and I think I'm worth $10 million, so I want to raise $1 million and give you 10% of my company."
Like Shark Tank.
Yeah, and they get crushed. Professional investors will just not pay any attention to you because you obviously don't know what you're talking about.
Right.
Basically, what they're thinking. Whether they say it or not, they'll be nicer usually. But,
I'm nice. But it's true.
So let's walk through that math real quick, just so people understand what we mean by valuation, pre-money, post-money, and all that.
Okay. So when there are a number of different ways to arrive at a valuation for your company. And it's really hard to do that before you are generating revenue, right? That's a tricky one. And so that's, a lot of businesses will self-fund or kind of take on some angel or friends and family money till they get to a point where they're ready to raise a bigger round, right? A more qualified round for the business. There will be a valuation assigned to your business at that point in time. Your pre-money valuation is what you in the market or your investors agree your company to be worth today. And your post-money valuation represents the capital that you raise that's now on your balance sheet that increases it by the amount of capital. So your post-money valuation is your pre-money valuation plus the amount of capital that you raise.
So if I talked investors we agreed that my company, my seed stage company, is worth $3 million. That's my pre-money valuation.
That's your pre-money.
And I'm raising $1 million from that. So my post-money valuation is
$4 million.
$4 million. So the math is easy. And that means how much dilution did I take? How much less of the company do I own now?
25% less.
Right. 1/4. So 1 million out of the 4. So you just take the amount you're raising divided by the post-money value, and that's how much dilution you have.
So now you used to own 100%, and you need to understand that 25% of your company at that point in time is worth $1 million.
So
look at this beautiful graph that we have for you.
Every time you raise money, that happens to you again.
Yep.
And theoretically, what this graph doesn't quite show. I don't know if you can, well, describe what it is first, and then I'll point out the flaw in the graph.
Okay.
But I just noticed.
No, that's fair. So at the top of the graph here, the orange circle is you owning 100% of your company and feeling great about it, but you also don't have any money to put towards marketing or pay yourself or do a whole lot, right? You're kind of just really launching. So maybe you're self-aware and you think, gosh, I'm really great at building tech, but I'm not really great at the finance side of things. So you take on a co-founder, or maybe you started with a co-founder. Now you're 50-50. So you're already down 50% of your company. And then you look to friends and family. That's our third step on our little path here. And they give you some money and nobody really knows how to value it. So there's just kind of an arbitrary percentage in exchange.
And you're a good salesperson. You're an entrepreneur. So you're like, yeah, give me $100,000 for 5% of my company. Well, that implies a value.
That does imply, but Tim, what's the value there?
And usually it's higher than it should be.
It is. Yeah, usually. And so if you record that, technically your next round will be a down round because.
Well, that post money, the 100,000 for 5% is what, 2 million? So it's 2 million posts. So now if you talked your uncle into giving you $100,000 for 5%, your company's now worth $2 million, theoretically.
That's right.
In your mind.
But then let's say you go to an accelerator and the accelerator says, hey, we're going to put in, 100,000 for a different percentage. This is our typical, everybody's valued at the same because we do 100,000 for,
5% or
6%. Sometimes that's a down round from your friends and family round because you valued your company very high and your friends and family are now diluted, as are you. So that's another slice of the pie there.
Yes. And again,
then angels come on. This is honestly the typical path of fundraising, right?
And where people sometimes get in trouble up through the angel stage predominantly is these negotiations are happening with companies that don't have a lot of financial history, and the valuation can be all over the map, as you mentioned, and people can get upset because they say, I bought at $1 a share. Everybody thinks about share price. And now you're telling me it's worth 50 cents a share. I'm not happy.
Right.
Well, that's because if they're not professionals, they haven't been in the business every day, they don't know how to value a company at that stage.
Yeah.
And so sometimes entrepreneurs can get stuck because they've raised money successfully, but the valuations have not been consistent with other market valuations.
So you wind up with, I just did a deal recently with a company with a very complex cap table. It was a Series B, but it was G shares. And so, you think about, as an investor, when you look at a capitalization table, there are certain things that you look for. Your capitalization table is everybody who owns part of your company and any debt and options for employees and, everything that sits in terms of an ownership claim goes into your capitalization table. And that's typically an Excel sheet that just says, here's who owns my company. And so investors really like to look for a clean cap table. And by that, I mean, you raise certain shares at one valuation. The next time you got to raise money, the valuation increases in line with sales and progress of the company. And you like to see kind of clean ownership. You don't want to see 50 people with a small slice and then one person who negotiated a giant stake for a weird valuation, and things are just off market. So it's really important to gut check where market is, how your cap table progresses naturally as you raise more money and progress as a company, and don't get weird stuff going on.
Super good point. I see this a lot. And my rule of thumb is keep it simple. I mean, when you get to be a big business, things will get plenty complicated. Yeah. When you're a small business, when you're less than 10 million in revenue, there is no need to make things more complicated than they already are. And so one of the things, people do it all the time because it's just kind of the reality of trying to raise money. So if you do plan to raise money, I'd encourage you to build a model and test it with mentors, advisors, or investors for each of the subsequent rounds of financing you expect to do for the next 5 years to benchmark and see if your plan is realistic or not.
Right.
And to understand what those valuation expectations are. There are some really easy, simple rules of thumb. Like if you're in a fast-growing company, you'll raise money every 12 to 18 months.
Yes.
And you'll take 20 to 30% dilution in every round.
Right.
Okay, so pretty much count on it. Every time I raise money, so I just raised money from my uncle, $2 million post money.
Yep.
He's going to expect it to double, right? So my new pre-money, I need to make enough progress to raise more money at a $4 million valuation or higher.
That's right.
And maybe I raise $500,000 then.
Yep.
Right? And that's not bad dilution. And then 4.5 doubles to 9. So it follows a pretty basic progression, but if nobody's ever explained that to you, it can be confusing. And that's the confusing thing about this chart.
And what about liquidity stack?
Well, no, that's 401. But this chart, what I noticed about this chart, Sarah, is what they don't show is that theoretically, if you're building the business, you have real revenue and profitability, those pies are getting bigger. So you're okay being diluted because your 25% is not worth $25,000, it's worth $25 million.
Right. Yeah. Do you want to own 100% of nothing or 10% of $1 billion company? Not that that's anybody's going to come to you with that proposition, but that's why people raise money. They want to grow the value of the company and they're willing to give up a percentage ownership. But you got to have to know at the end of the day, if my company is worth X and I want to make Y, I can't suffer more dilution than Z.
And Bianca just asked the question, how much dilution should you give up, et cetera, et cetera. The good news, Bianca, is there is benchmark data out there.
Yes.
That answer is knowable. You can find out what's appropriate. The general rule of thumb is you do want to be careful in the early days of giving away too much, but you are going to give away equity. And if it helps build a better, more valuable company, it's worth it. So there are benchmarks out there that you can, find mentors, advisors, et cetera, others that might have it. But, generally speaking, for example, a founder who's still the CEO of a company, even when the company's late stage has grown, is still going to own somewhere between 5 and 15%.
Mm-hmm. Yep.
Okay, but they're not going to own 50 unless they grew that company without raising money.
Right.
Which, by the way, plenty of companies do. There are plenty of unicorns like MailChimp, for example. MailChimp, I don't know if they've raised money now, but when I talked to one of their founders a couple of years ago, they were up to 450 million in revenue and still growing by 50% and had raised zero outside money. So what does that tell you? It actually tells you the most important source of capital that we didn't talk about is customers.
Revenue. revenue from your business operating
That's what you should be most obsessed
in
about.
excess of your expenses.
That's what you should be most obsessed about, is getting customer funded growth.
Yeah.
If you can do that, you have a good business. And that relates to a rule of thumb. I always talk about the first law, which is capital follows growth, not the other way around.
That's a good law.
People mess that up all the time.
They
say, well, that company is doing what we do, and they just raised $20 million. I'm like, because they could, not because they needed it.
Right. Yeah. If okay. So Tim, I know we have some minutes left, but is it easier to raise $50,000 or $5 million?
What was the bigger amount? 5 million?
Yeah.
Yeah. 5. It's easier. The bigger the number, the easier it gets to raise.
Yeah.
And usually that's because you have all the data, you have the metrics, you have the evidence.
And it opens up a whole new source of funding, which are professional funders.
And then you get to pick.
Yeah.
That's the neat thing, is you get to pick which investors
who comes on.
have the privilege of investing in your company.
But so from an investor's perspective, right, you can write $10 million checks, like 10 $1 million checks, or one $10 million check. And you either do the accounting and track and go to the board meetings for 10 companies or for one.
Mm-hmm.
And so there's an efficiency consideration on the investor side too. That's why you're often pushed to take more when you get a certain.
And that's why it's important to know who your investors are, what to look like. We want to invest. Our first check is usually $2 million, right? So somebody can say, well, we're too early for refinery. Could you just give us 100,000 or 200,000? Well, no, that just doesn't work. That's not. I'm looking to invest in about 10 companies at $2 million each.
Yeah.
If you want less money, it just doesn't fit, right? I have to make $2 million go to work.
Yeah.
Like I have to put it to work in a company, and that's going to be true for every investor or bank or anything else. They're going to have their criteria, and the more you can understand their investment criteria, the easier it is to fundraise from them.
Yes. Yep. And to target your fundraising to the right people.
Absolutely. That's when we were doing centrifuges.
Right.
And this was just when you and I were there together at the same time, and we would help some of the entrepreneurs in Cincinnati, if you remember, try to make introductions to investors. And so many times the entrepreneurs would come to us and say, well, I got to raise money. It's like, okay, great. Who should I raise money from? And I don't know if you remember this, but they hadn't done the homework to have a list.
No.
And so I
didn't always know how much money they needed.
Yeah, one is not knowing how much they needed. Then
don't ask an investor how much money you need.
Right. Have that figured out. 2, have a list. It's usually less than 10 names.
Yeah.
Of not even firms, but people.
Yeah.
That should be investors in your company.
Yeah.
Meaning they've invested in companies like mine before. They understand it. They're going to get the market. They're not going to have to be convinced that the market problem exists because they already know the market.
Right.
Right. You need to have that list, and you need to know who funded all of your competitors.
Yeah. Yep. Look at your competitors, see who's on their cap table, and think about the types of funds that are interested in those types of companies, or angel investors who have found success in your industry and you could benefit from their expertise, and they see a promising young entrepreneur and want to put their own capital in. So there are lots of options, but I will say having an understanding of the value of your equity and the value of $1 and the value of the dollar today and the value of the dollar tomorrow is super important when you're thinking about how to raise money and whether you should raise money.
And maybe this is a good point to end on, which is Pranav's question. Any tips on being successful when looking to raise money at a good valuation? Again, capital follows growth. If you have good numbers, you make sure you have good numbers. And those metrics, by the way, in the early stage may not even be revenue. You could have, there's other forms of growth,
right?
Evidence of growth. It's not necessarily revenue.
Nope.
And you can assume a certain conversion down the road.
Right.
But if a lot of people are using your freemium product and you have a million using it and you're going to monetize 5% of them, that's not a risky bet.
Nope.
So it's not always revenue.
Companies who need to raise a lot of money first, like if you're in biotech or something in the pharmaceutical or medical space, right? You have to raise tens of millions of dollars before you can sell your product. So, there are it's industry specific, but you can Google, right, you know, revenue multiples for a technology company, and then see where companies are, you know, is it 10 times revenue, 20 times revenue?
And you'll quickly start to scope in on what's right. And then,
Yeah.
so finally to Pranav's question, at the end of the day, the market determines your valuation, which means you need to have at least or more than one potential investor.
Yes.
So if you can get 2 or 3 investors who all are interested in investing, then you can find out what they're thinking. One says you're worth 2 million, another says you're worth 3, another says you're worth 5. Then you have the decision of saying, okay, my valuation is between 2 and 5.
Yeah.
It's not 10. And then which is the better investor?
Right.
So you may take the $3 million valuation, not the 5.
Right.
Because it's a better investor, somebody who's going to help you grow the business, somebody that you get along with.
Yep.
That's the answer.
That's the right answer. Because at the end of the day, evaluation at seed or Series A stage shouldn't be your goal. Your goal is to ultimately exit the company.
Yes, you make money on the exit, not on the not on the fundraising.
All right.
How was that, Zan? Abby?
Did we cover the right things?
Fantastic. Yes.
We didn't have a musical guest, but we did have a jackhammer.
I told him to bring his guitar.
You should have, but I mean, guitar aside, I thought this was a great little presentation. I don't know, like you said, if it was a pocketbook, I don't know how you can put a Zoom in a pocketbook, but there are definitely some helpful tips and also some learning and education in your presentation, and we really appreciate it. Thank you so much for joining us today.
Awesome. Thanks, guys. Feel free to take the survey and give us a good grade. If we're getting graded.
And thank you so much
again.
to all the students and guests who joined us today. We really appreciate it. We do have a couple webinars coming up, so if you want to check the Eventbrite or the Entrepreneurs Change the World schedule, we'd appreciate it. And like Sarah said, please, 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 if you have a second, feel free to take that survey. Thank you, everyone. Hope you have a great weekend.
Thank you, Tim and Sarah.
Thank
Fantastic.
you again, Tim and Sarah.
Bye. Thanks, Abby.
Bye.